Good evening, everyone. Today we're looking at financial reporting, and we'll continue from our last week topic, which is income tax. Last week we've talked about the objective of the standard and the scope of the standard. Talk about the scope of the standard. I will also discuss the terminology under the standard. What are the definitions under the standards? Talk about the current tax. We talk about how to compute the tax computation. We said accounting profits is different from taxable profits. So, and the tax rate should be based on taxable profits, and the tax rate should be based on taxable profits, because there is always allowable and disallowable deductions. So I gave us a format for how to compute a taxable profit. So, and this is all the same thing with that of the taxation in our previous class. We also look at the calculation of income taxes. So the income tax that we recognized in our financial statement, which is the profit or loss statement, is always a provision, and the provision will inculcate over provision in the previous period, and under provision in the previous period, including the increase in deferred tax provision and decrease in deferred tax provisions. So we said this must be included before we derive our current tax that will be stated in our profit or loss. So our last class we stopped at illustration 1, which is the Bologina, and I've explained it with the solution. So today we will look at the major item or the major area of the standard, which is deferred taxation. Deferred taxation is very, very important, whereby most institutions or companies or entity, they try to shy away from it. They don't want to recognize deferred tax. They just want to take the view of the government. So they don't want to look at the difference between the government's position in terms of items in a financial statement, and so they just shy away from the accounting requirement, like IAS 12, and there is no deferred tax provision in the financial statement. For entity that understand this standard very well, they will provide for a deferred tax implication in the on the items of financial statement. So today I won't bore you with explanation. You read the note and you read the note, then you understand more of what I'm trying to say. But we're going to look at more from the calculation aspect of the deferred taxation. As I said before, we said the reason why there is deferred taxation is because the difference in the accounting profit and the taxable profit, as I've said earlier, and this difference is what that warrants the government for taxing the company in a different way, while the accountant will tax the profit in a different way. So this difference will warrant a temporary difference that I've explained earlier. So we said the difference arises due to the fact that the tax authority follows rules that differs from the IFRS rules in arriving at the taxable profit. Yes, because we said the tax they will use other rules which is they disallowed depreciation. Transactions which are recognized in the accounts in a particular period may have their tax effect deferred until a later period. So that is the meaning of the deferred taxation. Accounting will recognize a transaction now, while tax will say no. So mostly they are incomes. These incomes are income that does not warrant cash. Remember that we say in taxation, our tax they are based on cash items. That means when you make cash sales, that's when we pay tax. And it is convenient to emphasize two separate sets of accounts, which is one set constructed following IFRS rules, and the second set following the tax rules of the jurisdiction in which the entities operate. So the difference in the two of these rules will result in the different numbers in the financial statement and in the tax computations. This difference may be viewed from the perspective of, so that this difference may be viewed in two perspectives, which will be, you can view this difference in the perspective of the financial statement. That means you can look at the temporary difference. You can compute your deferred tax liability using the items of a financial position, which is the balance sheet, or items in the profit or loss. That means when we say items in the financial statement, we are talking about your assets and your liabilities. Now, for assets and liabilities, they have. Then you can also look at your income and expenses, which is in your profit or loss statement. So these are the two perspectives in which you can compute your deferred tax liability. Now, this illustration 2 give us a broad understanding on the deferred tax liability. But before I solve this question, I will want us to understand. We'll go back to this question and the solution. I want us to understand what is the tax base. Because we actually need this. So, what are the tax base? So, the tax base of an asset or liability is defined as the amount attributed to that asset or liability for tax purpose. I have seen tax base before. I would say temporary difference in the difference between the carrying amount and the tax base in the financial statement. So, and the temporary difference might lead to taxable temporary difference, which is a credit balance, or which is a liability, or deductible temporary difference, which is a debit balance, which is an asset. Now let's talk about the situation where temporary difference may arise. It is in our exam, because this standard is one of those standards we must understand very, very, very well. Income tax. They might, if they don't bring us a calculation, they may give us state examples of area whereby there will be temporary difference. There is area that will lead to deferred tax liability, because there won't be deferred tax liability if there is no temporary difference. That means if the carrying amount is not different from the tax base, so there won't be temporary difference. And temporary difference will not, because there is some item that will be recognized in the financial statement now in IFRS, but in a tax perspective, that item will not be recognized now. That is also a temporary difference. So when income or expenses is included in accounting purpose in one period, but included in a tax profit in a different period, for example, so there will only be a temporary difference when is the timing of recognition of an item in the financial statement. It will lead to a temporary difference. I would say one situation where the accounting depreciation does not equal the tax allowable depreciation, which is capital allowance. So what warrant a temporary difference is our depreciation and the capital allowance, but depreciation warrants a temporary difference. Items which are taxed on cash basis, but which will be accounted for on an accrual basis. Remember, there's some items that will be taxed on cash basis, while some will, but in accounting does not recognize a cash basis. Accounting uses accrual basis. That means income that is being earned will be recognized in an accounting purpose, but for tax it will not be an income. It will be disallowable income. So it is recognized when you actually sell that asset. For example, the valuation surplus is an income that will be recognized in our fair value gain. It's an income that will be recognized in our profit or loss. But for the tax purpose, fair value is not an item of cash, so it will not be recognized in the for tax purpose, because tax follows cash basis. Finance lease recognized in accordance with the provision of IAS 17, which is now IFRS 16, but which for to be treated as operating lease under local legislations. Now, evaluation of assets. Evaluation of assets is also an example that will lead to temporary difference. So when you value an asset, you might have evaluation gain or evaluation surplus or evaluation deficit. Where the tax authority does not amend the tax base when the asset is revalued. The tax base of an item differs from its carrying amount. So when the tax base is different from the carrying amount, it is also warrant a temporary difference. For example, when an entity receives non-taxable government grants relating to assets, so government grant, non-taxable government grant will also lead to a temporary difference. Then cost of a business combination, yes, the cost of a combination will also lead to a temporary difference that we adjusted for fair value. So fair value will also lead to a temporary difference. Now, let's talk about the recognition of a deferred tax liability. How will you know that this is a deferred tax liability? A deferred tax liability. The rules. Now, when we say a deferred tax liability, deferred tax liability might be derived from either asset or liability, or income and expenses. And a deferred tax liability will lead to a credit balance in our financial position. Then it also will debited to our tax it will increase our tax provision in the profit or loss statement. So a deferred tax liability should be recognized for all taxable temporary difference, unless the deferred tax liability arises from. So it's always when it arises from goodwill, then we don't recognize a temporary difference, because goodwill will not warrant a temporary difference. Goodwill and the initial recognition of an asset or liability in a transaction which is not a business combination, as the time of the transaction affects neither the accounting profit nor tax profit. So any account any item that will not affect accounting profit nor tax profit, there will not be a tax liability on that asset. Recognition of a deferred tax asset. What's the deferred tax asset? Deferred tax assets will be an income in our profit or loss. That will credit our profit or loss and debit our deferred assets. This is deferred tax asset is a non-current asset in our financial position. So deferred tax assets should be recognized for all deductible temporary difference. So when we say deductible temporary difference, it's a deferred tax asset to the extent that it is probable that taxable profit will be available against which the deductible temporary difference can be utilized, unless the deferred tax asset arises from the initial recognition of an asset or liability in a transaction which is not a business combination. At the time of transaction, neither it doesn't affect the profit nor the accounting profit. So a deferred tax asset will also be recognized for the carry forward tax loss. Tax loss that will carry forward is also a deferred tax asset, and tax credit. So a tax credit note is also a deferred tax asset, because you're going to relieve your tax in a future period, to the extent that it is probable that the future taxable profit will be available against which these losses and credit can be used. So now this is, I give us, so let's solve the question. Then we'll now look at a summary of approach. So summarize everything on how to calculate our deferred tax liability. Let's go back to the illustration 2. So illustration 2 is very so as let's see, as the question is, you need to understand it very well. So I will explain the solution so that you will be able to understand the solution and we'll be able to solve our own question. Florentina Limited bought a non-current asset on 1st of January 2011 for 9,000 naira. This asset is to be on a straight line basis over 3 years. So it will have a depreciation over 3 years. So it's line basis. So every year we recognize 3,000 naira as what? As depreciation, which is 9,000 divided by 3. 3,000 naira as depreciation. We are giving the capital allowance for year 1, which is 4, year 2 is 3, then for year 3 is 2,000. It's 2,000. Now you are required accounting profits for each of the years, like 2011 to 2013, is budgeted to be 20,000 before accounting for depreciation. I mean, the profit before depreciation is 20,000. That is the profit after depreciation, like your profit before tax, is what will be 17,000. That means you will less depreciation of 3,000. And the income tax is to be charged at 30%. At 30%. At the end of each reporting period, the deferred tax liability might be identified from the perspective of financial position or profit or loss. So you are told that we should calculate a deferred tax liability under 2 perspectives: the profit or loss perspective and the financial position perspective. So and we should also account for our financial statements. We should draw a set of financial statements. Now, for this question, what we need to do is that where we are giving a non-current asset of 9,000 and we are giving the capital allowance, so we know look at items that will affect the financial position and after that will affect the profit and loss. The first thing that you look at in this question is to compute the tax, because you are giving budgeted profit. So you must know the profit for the period. So the first thing that we need to do is to look at draw up our profit or loss. And our profit or loss, the extract will be the profit before tax. Now, and the profit before tax is what? 17,000, which is a profit before depreciation is 20,000 minus depreciation will give us 17,000, which is profit before tax. Then what is our tax that will be charged is what we don't know. Now, I remember that our tax as in our previous class, the tax that will be charged must include deferred tax liability. That means your normal provision, and your provisions, as I've said before, should be based on what? Taxable profit. That means you must compute your taxable profit. So this our workings 2, which is our tax that will be charged. It will be based on what? Our taxable profits. Then that means we work back. Then let's look at the solution or workings to the taxable profit. Now our current tax for 2011, which is 4,800. So which is our income tax. As we will look at the adjustment. Sorry. Look at the adjustment. Now our profit before taxation. Profit before taxation is 17,000. Then you add back, because we've said before we look at our tax rate must multiply it on our taxable profit, not on our accounting profit. Not 70,000. It must be on taxable profit. That means you must work back. Now you add back depreciation of 3,000. Then you less what? Capital allowance of 4,000. So 2011 we have 16,000, 2012 we have 17,000, 2018, 2013 we have 18,000. Then we multiply the 30% on it, we have 4,800, 5,100, and 5,400. So this is our current year provision for tax. Then that is what is there. Then the next thing is that we will adjust for what? Your deferred tax. Remember that we said deferred tax also affects our profit or loss. So that also affects that is the accounting for deferred tax. Now, how do you get the deferred tax? Your deferred tax, you must compute the temporary difference. That means you must draw a schedule that will show all the items. If you are using the profit or loss perspective, all the assets, all the income and the expenses, or if you are using the financial position with balance sheet perspective, you must write all the assets and the liability. Then when you write that, you will write the kind amount and the tax base, then the temporary difference, which is the difference between the carrying amount and the tax base. That will lead to deferred tax liability or a deferred tax asset. So let's look at calculation of temporary difference. We must calculate the temporary difference. This temporary difference is what we multiply our tax rate on. It will give us our deferred tax asset or deferred tax liability. Now here I made the because the only item that we have here of income of profit or loss is our depreciation that will be charged, which is depreciation and what our capital allowance. So for carrying amount is depreciation, while for tax base it will be capital allowance. Remember that when we say your depreciation minus your cost of the asset minus the deduction will give us our carrying amount, which is our for the asset. Now here I draw a schedule, which is the difference in the asset and liability, which is the system of financial position, the perspective of financial position. That is what is there, and the income and expenses perspective. That is what is here, which is the profit or loss. Now in 2011 we have the cost. Remember that I said in our note that we said that there would be temporary difference for the initial recognition of an asset and a liability. So that is why the initial recognition of the asset is 9,000. So no temporary difference for the asset. But why the carrying amount is when you subtract the depreciation of 3,000 from the 9,000 cost, we have a a cost of or carrying amount at the end of 2011 as 6,000, while the tax base is when you subtract the capital allowance from the cost, you have 5,000. Now here the carrying amount is higher than the tax base. The carrying amount is higher than the tax base for which is the carrying amount of the non-current asset. This will lead to a temporary difference, which is there are difference of what? A difference of what? 1,000. And this difference of 1,000 is as a result, it might lead to what? A deferred tax liability. Or maybe in our next class I'll try to simplify it for us so we can see a shortcut, but mostly you should be able to understand it without a shortcut. But when the carrying amount of an asset, so this differently 1,000, which is in a final position, because we said the carrying amount of non-current assets will appear in our financial position. So that is why I put it under financial position, which is asset and liability, 1,000. But depreciation and the capital allowance also have a temporary difference of what? 1,000. So it is under profit or loss, because this item of depreciation will affect what? Profit or loss. So in 2012 we have a depreciation of how much? Of 3,000, and the capital allowance of 40,000. So there is no temporary difference in 2012. So that is why it is nil. But by the time you started, you have a carrying amount in 2012 at 3,000 and 2,000. So we also have 1,000 temporary difference in a financial position for the asset. Then in 2013, when you subtract your depreciation from your carrying amount of 3,000, you have nil. So in 2013 there is no temporary difference in our financial position, because the asset has been fully utilized. So no more carrying amount, and there is no tax base because of we will subtract our capital allowance. But you will charge a depreciation of 3,000 in 2013 there, which is and we have tax base, which is capital allowance of 2,000. There is temporary difference of what? 1,000. So after it got a temporary difference, the next thing is to multiply our tax rate on a temporary difference to know if you have a deferred tax liability or deferred tax asset. Now let's look in the perspective of the profit or loss. Sorry, in the perspective of financial position. The carrying amount. No, I now pick out all the carrying amount in each year. In 2011, the carrying amount is 6,000, and the tax rate is 5,000. So we have temporary difference of 1,000. Right? In 2012, we have a temporary difference of what? 1,000, and in 2013 we do have no temporary difference. So, and I've told us that when the carrying amount of an asset is higher than the tax base, the temporary difference will lead to what? Will lead to a deferred tax liability. When you multiply the tax on it, will lead to a deferred tax liability. When the carrying amount is higher than tax base, will lead to what? A temporary difference of what? Which will be a deferred tax liability. So we have a deferred tax liability of 300, then another 300 for 2011, 2012, then 2013 is nil. Why for profit or loss statements, I now bring out the carrying amount, which is the depreciation and the what? The tax, the capital allowance. Now in 2011 we have a temporary difference of what? Of 1,000, and in 2012 no temporary difference. In 2013 there is temporary difference of what? 1,000. Now, and here the temporary difference will lead to what? In 2011, this is, remember that depreciation is an expense in a profit or loss, and how will it warrant a deferred tax liability or deferred tax asset? When when the tax base is higher than the carrying amount, it will lead to a deferred tax liability for expenses. That means expenses is an opposite of asset. That means what transpire in asset, that is how we arrive at our deferred tax asset or deferred tax liability under asset is the opposite to what? Expenses. That means when the carrying amount is higher than the tax base, it will lead to a deferred tax asset. So a deferred tax asset. So I put it here. So A here is means asset. That means this 1,000 here is an asset, while this bracket of 1,000 here is a liability. That means because the tax base is higher than the carrying amount, it will lead to deferred tax liability for expenses. So when we have this, very simple. In our double entry for this item is that in 2011 you are going to debit this 300, which is a deferred tax liability. Deferred tax liability means that the accounting treatment for deferred tax liability, please remember this, is that when you have a deferred tax liability, the accounting treatment is that you will debit the profit or loss and credit our financial position. So that when you debit means it will increase our provision for tax. That means increase the provision for tax. So when you have a deferred tax asset, you will credit your tax account, your tax in the profit or loss, and then debit your deferred tax assets in our financial position. This is always a non-current asset and non-current liability. So that is how we have our deferred tax. So here we debit it to the current tax, which is, it will now increase to 5,100. Here there is no tax, no profit or loss. Here remember we say is nil, which is also so let me show you. In 2012 is nil, no temporary difference. So for profit or loss is nil. Why for 2013 we have 5,400 then minus, which is you will credit our profit or loss with 300 for the tax assets. Another asset is an income, which will reduce our current year provision. So that's why we have 5,100. So this is our tax that will be charged. So then our profit after tax is now 11,900. So how will it affect our financial position? In our financial position here, the tricks here is that in our financial position, this deferred tax is our closing balance. As I've said, it's our closing balance. So in 2011 the deferred tax balance, which is a liability, is 300, while in 2012 is also 300. That means no movement. There is no movement, no increase nor decrease. That is the meaning, no increase or decrease. While in 2013 there is nil, so there is a decrease. That means you must have credit your profit or loss and debit our deferred tax liability, that is why we have a nil here. So here in our financial position, our opening balance, no, we are not giving opening balance. Then our movement, which is that movement here is the ones in the profit or loss. That means the items that were debited, the deferred tax liability that was debited or credited in our profit or loss, which is in the the current year tax. So here we credit our the deferred tax liability. That means we debited the profit or loss and credit our deferred tax liability. That is why we have a closing balance, a balance of 300 for 2011. For 2012, the closing balance of 2011 will be opening balance of 2012, and there is no movement in deferred tax. So that's why the closing balance is still 300. Why the opening balance is 300 and there is a movement which is a credit to our profit or loss, then a debit to our deferred tax liability account. That is why we have a nil. That's why we have nil. So when you look at this, we explain this so you can look at it very well. If there's any question we should ask, we should always ask question. I find that we don't ask question, or is it that we understood this with hook, line and sinker? So if that is the case, we'll talk about the situation where that warrant a temporary difference. Talk about now let's look at our measurement issues. So here I give us a summary of approach. So we can look at the summary of approach. That means how to account it. Though I've already using an illustration to explain the summary of approach. The first thing you have to do is to list all the assets and liability, write the carrying amount, write the tax base, and the difference between them is the temporary difference. So once you have a temporary difference, you multiply with the tax rate, will lead to either deferred tax liability or deferred tax assets. So, and I've talked about the accounting treatment, the movement in deferred tax balance. So you can also read the note up and understand and ask question. Now let's look at illustration 3. Illustration 3 now does not look at both the asset and liability. So we are giving that Bonic as at December 2012, it has this kind amount and the tax base for non-current assets, which is for plant and equipment, 200,000 and 175,000. For trade receivables, we have 50,000, and we have a note 1 for that. While for interest receivable is what? Is an income. Interest receivable is an income. Interest receivable is an income. So we also have payables. For payables, we have fines. And we also have interest payable. We have interest payable. How do you arrive at interest payable? Interest payable, we must debit our profit or loss, which is an expenses, and credit our financial position, which is a liability. Interest payable. Now for the trade receivables, we are giving the note. The note says the balance is 55,000 naira, while a doubtful debt provision is a 5,000. That's how they spread 5,000 from 5,000. That's why they got 50,000. Now further information, the deferred tax balance as at 2012 is 1,200 naira. 1,200 naira. So you can look at you are giving the tax rate, and we are giving that provisions is not allowable expenses. As we are told that the fines are not tax deductible, so you don't deduct tax. So fines is not an expenses. So it's not an expense at all. I mean, it will not warrant a temporary difference as long as in something that we deduct in our accounting, and the tax said they will not deduct it. Never. So not in the future and not now. So that means that it does not warrant a temporary difference. So let's look at this illustration. Solution to this illustration. Now, as I've said before, we have to write the item, which is the non-current asset, the current asset, income, and the payable, which is expenses. Payable is also is expenses. So the kind amount for all these items will be listed, and the tax base will also be listed. And the difference, the temporary difference. So when you will sum all the temporary difference, the one that look alike. I said deductible is for assets, which is that I bracket it. While taxable is a liability that it does not jacket. So let's look at under non-current asset equipment. We have kind amount of 20,000 and tax base of 175,000. The temporary difference of what? 25,000. So it's taxable, which is taxable. It's taxable. That means taxable means it will lead to what? Tax liability. A different tax liability. Now for current asset, which seems as an asset, we are told that the kind of amount given to us is 50,000. But tax base is what? Is not 50,000. Tax base is 55,000. How do you get 55,000? We have to add back, because the amount of trade is 55,000. They did not deduct a doubtful debt provision. I remember that in our tax provision is disallowable expenses, though it is only a specific provision that will be allowed. So we now add it back. That is why we add it back to get 55,000 for tax base. So under tax perspective is not 50,000. It will be what? 55,000. Now we will add back disallowable expenses, which is provisions. Then we have a temporary difference of what? 5,000 naira, which is deductible, which is what? A deferred tax asset. So we have income. For income, we are told that the income for the tax perspective, the tax said it will be on a cash basis, but accounting recognizes now for accrual basis. That means there will be a temporary difference because of the deduction, the period where the tax where there will be tax on that interest receivable. So that is why for tax for that year is new. So you add it back, so it will give us new. You add this back from 1,000, you add it back to give us new. That's why I put it with new. So we have a temporary difference of 1,000 because of why for current liability we have fines. Does not warrant a temporary difference, so it's also 10,000. It will be nil. Why interest payables is what? 2,000 for kind amount. For the tax base is what? Is nil, because the interest payable also warrant a temporary difference. Now we have to summarize the total temporary difference. For tax liability we have 25,000 plus 1,000, which is 26,000. Then for deferred tax assets we have 5,000 and 2,000, which is 7,000. So when you multiply tax with it, we have a liability as at the end of 2012 as 5,700. Now let me give us this hint. For assets, for all assets, either current or non-current, when the kind amount is higher than the tax base, it will lead to a deferred tax liability. I repeat, for assets, when the kind amount is higher than the tax base, it will lead to a deferred tax liability. But when the tax base is higher than the kind amount, it will lead to a deferred tax asset. Now for income, when the kind amount is higher than the tax base, it will lead to a deferred tax liability. That means income and assets are the same thing, the same method, the same procedure, the same result. Income and asset. While for expenses, when the carrying amount is higher than the tax base, it will lead to a deferred tax asset. So expenses is opposite of what? Of asset, and expenses and liability are the same thing. So when the carrying amount of expenses is higher than the tax base, it will lead to a deferred tax asset, which is the same thing to a liability. So how will it affect our profit or loss? We were given the opening balance of 1,200. We have a closing balance of what? 5,700. Then the difference, which is the balance figure, is 4,500. Is what will lead to that's what will affect our profit or loss. That means you will debit your profit or loss as a deferred tax liability, as a deferred tax. Then you credit the opening balance of the deferred tax liability, and you now have a closing balance of 5,700. So with this, we've come to the end of the next class. Then our next class will also look at another questions under income tax. Then we call it a day for deferred tax IAS 12. Thank you for your time.